Welcome to the FedLife podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FedLife podcast. Once again, I am your host, Dan Sipe, and additionally, as you already know, I'm the branch manager here at Serving Those Who Serve and Lee Sipe and Associates. Beginning, as I always do, to say thank you for your service to the country, to all of us. You don't hear that enough, you'll always hear it here. As I've said so many times, you are the glue that holds everything together. And the other person that helps us hold everything together is the guru. And he is back with us again, Ed Zurndorfer, as part of our ongoing mission to reach, teach, and serve you. And at the outset, as I always do, I need to say the opinions of Ed Zurndorfer are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and not intended to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you don't have a personal advisor, if you are looking for a place just to get some questions answered, hit us up at Serving Those Who Serve. That's STWserve.com. You will see the place where you can ask a question. As we always do, we're following Ed's FedZone articles, which you can always find at fed-zone.com. One more way that we can reach and teach. And today we are wrapping up taxes. So you most likely know by now that we had an extension until May 17th for filing. So by the time this airs, that date will have passed. But as Ed is always keen to point out, there are a few additional points to cover, and that's what we're going to do. So Ed, let's jump in. You wrote articles on the child tax credit and some of the delays in refunds. So let's jump in on the tax credit. So the American Rescue Plan Act of 2021 expanded the child tax credit to help folks with children during the pandemic. So Ed, walk us through that. Tell us about the changes.
Okay, so the American Rescue Plan, which was passed in March 2021, expanded the existing child tax credit that has actually been around since 1990s. At that time, you got a $1,000 tax credit for a child that was under the age of 17. And it stayed that way for probably almost about 25 years. I need to emphasize that the tax credit is a credit. The mere fact that you have a child at home that you are supporting, of course, the government gives you a $1,000 tax credit, which is a dollar-for-dollar reduction in your liability. The tax credit has always been subject to income limitations. That is, if your income's too high, you will not get that credit. And the income limitations were really, for people who earned over $100,000 a year, it really meant they could not get the credit.
Sure.
But then in 2017, the Tax Cuts and Jobs Act expanded the tax credit up to a doubled amount to $2,000 per child, again, for every child under the age of 17. And they expanded the income limitations, meaning that individuals whose income was much higher, particularly instead of $100,000 income limitation, they doubled it to $200,000. That's for single individuals who have children in the home. And then for married couples, it went to $400,000. So more and more individuals, starting with the 2018 tax returns, were able to take the child tax credit. But then with the American Rescue Plan, they expanded it even more, meaning that to children under the age of 6, the tax credit was expanded for each child under the age of 6. The tax credit was expanded to $3,600. That's another $1,600. And for children who were between ages 6 and 17, the credit was expanded to $3,000. Again, it's a tax credit, and more individuals were able to take advantage of this higher credit. However, with this expanded tax credit, the income limitations came in. I also have to point out that it really was not entirely, the expanded tax credit was really not expanded entirely as a credit. In fact, for the tax credit became effective, it will become effective on July 1st, 2021. And individuals who are eligible for it will actually see IRS giving out the money. You're actually, based on your 2020 income tax returns, if your income was below a certain amount, and I'll mention what those amounts were, the IRS would actually start sending out the credit amounts to eligible individuals' bank accounts, the same bank accounts they got their refunds.
Wow.
So it really was. But then the other half of the credit, let's say if someone was getting the expanded credit, which was, let's say, for a child under the age of 6, they would get half of the credit, the half of the $1,600, which was, I'm a little tough on figures here, $3,600. That's $300 a month, but that's actually, they go get half of it, $150 for the month of July through December 2021, and the other amount, of the $1,800, would be in the form of an adjustment to one's income when they filed their 2021 taxes. So it was not entirely a credit. So it really opened up the amounts that eligible individuals were able to receive.
Okay, got that. And so how does one qualify?
One will qualify based on the fact of based on their 2020 tax returns. If they had eligible children, again, any children between ages 0 and 17 that they claimed as dependents, they became automatically on paper entitled to this expanded tax credit. But again, it's sensitive to the amount of the credit they're going to get is based on, expanded credit, I should say, was based on their adjusted gross income for 2020. If their income was too high, they would not get the expanded credit.
And how do those income limitations compare to the original one?
I had a feeling you were going to ask that. Well, I emphasize for the expanded credit for single individuals, if they had adjusted gross income of less than $75,000, they would get the full amount of the credit. Also, that includes head of household separates, $112,500. And for those individuals who are filing as married filing jointly, there's an AGI limit of $150,000 or less. And there's a so-called phase out. If you're above those limits, then it would start phasing out the amount that you were eligible for. Again, based on 2020 AGI.
Gotcha. And folks, I'll reiterate, this follows Ed's article in the Fed Zone, fed-zone.com. So by all means, pull it together with this because he always puts great tables and charts in there to help you with it. So, Ed, let me ask you this, because as you know, I have children, and the one thing I've noticed about them is they get older. And so this covers kids up until 17. What happens if I have a child that turns 18 this year? Am I just out of luck?
You're out of luck. If they have to be 17, younger than 17 for all of 2020, if your child turns 18 on, let's say, December 20th,
right?
Sorry, no expanded credit. Now, however, I emphasize this is an expanded credit. If you have a child who turns 18 this year, they're not eligible for the regular child tax credit to $2,000, Dan, but many people are not aware of this, that if you have a qualified dependent who lives with you, I'll give an example. I have a client, I do their taxes, they're a couple, and the wife's brother lives with the couple. They support him. He doesn't have any income. So he qualifies for the $500 tax credit. So if that 18-year-old who would not be eligible for the child tax credit would be eligible for what's called the qualified dependent tax credit, which would be $500.
Gotcha. Okay.
So all is not lost.
Got it. Okay. Now, it sounds like the expanded CTC is a little tighter on the income. Does that automatically bounce them out of the original CTC based on this year?
Oh, no. The original $2,000 tax credit, those limits stay the same for AGI. $200,000 a single or head of household, $400,000 married filing jointly.
Gotcha.
Give an example. Our older son, who has 4 children under the age of 17, they do not qualify for the expanded tax credit, but all 4 of them who are under 17, they would, my son and daughter-in-law qualify for the regular tax credit, so they'll get an $8,000 tax credit for the year 2021 because their joint income's less than $400,000.
Gotcha. And you mentioned it just before, but you make a special note in the podcast that this is a fully refundable tax credit. Why don't we take 1 second on clarifying the difference between that and a deduction for folks?
It's very important to distinguish between what's called a refundable tax credit and a non-refundable tax credit. What a refundable tax credit means that even if you don't have a tax liability, you get this credit, which is you have a zero tax liability. You still get this credit in full, as opposed to a non-refundable tax credit that if the amount of the credit exceeds your actual tax liability. For example, let's suppose you had, I'll give you an example of a non-refundable tax credit. The child and dependent care tax credit. If you're paying someone to take care of your child while you work, you're paying nursery school tuition. This is called a child and dependent care tax credit. Tuition paying would be used as a credit that would offset your liability. But if it turns out you have no tax liability for the year, you're not going to get any credit. You have to have the tax credit. And if the amount of the credit exceeds your liability, you're only going to get up to what your tax liability is as a tax credit. Okay, so this is golden for some people.
Oh, sure.
Another example of a refundable tax credit is the earned income tax credit, in which even if you have a job, and there's income limitations for that too, but if it turns out that your taxable income results in no tax liability, you're still going to get the credit because of the fact that you had earned income.
Got it. Okay, well, that's a great primer for our feds. Now, let's go ahead and pivot to what is actually your latest article out there that covers delayed refunds. So we already have a backlog for 2020 refunds. What's going on there?
As we're going to find out in a few moments, there's still a backlog on 2019 refunds. Yes, Dan, the IRS is having some problems, and it's not really all their fault. But just to give you an idea that there's several reasons why the IRS has not been issuing tax refunds. Even people who filed let's say, as early as in February, they haven't gotten their refunds. One of the reasons is that the IRS is understaffed. They've had many, unfortunately, employee reductions. And also, the IRS has been asked to do so much with the staff that's been cut. For example, they had to handle the stimulus payments.
Sure.
And the result has been we had a filing extension for this year to May 17th. Last year, there was an extension for 3 months.
Sure.
And the IRS has been coordinating a total of 470 million stimulus payments.
Wow.
And also contributing to the problem is, during the middle of the tax season, Congress made some retroactive tax law changes for 2020.
Gotcha.
That this happened after millions had filed their returns, and the problem was the IRS had to fix those returns to take into account the last-minute tax changes. They had a real whammy here. So the result has been that they had to delay to giving out millions of refunds. Another problem has been that some people still insist on paper returns. And the problem with the paper returns is that somebody has to be at the IRS center opening the mail. And if these refunds are of significant amount, I mean more than $10,000, an IRS employee has to sit down and go over the return. As you know, most federal offices are not open. The IRS centers have been open. They've been closed because of COVID outbreaks and so on. And the result has been that this has slowed up the processing of paper returns, and the IRS now is still processing 1 million 2019 tax returns.
Ooh.
This has all pushed them to the brink here. that individuals, it doesn't surprise me that I get emails from clients. I file the returns. Where's my refund? I filed my return in late February, early March, and I'm still waiting for it. And all I can do is explain, well, unfortunately, your refund's very big and somebody has to analyze it, and that person is not there. They are overwhelmed.
Gotcha. And you mentioned in your article that a lot of the 2019s that are still out there are actually paper returns.
Yeah. This is something that individuals have to get used to. The paper stuff is just, I wouldn't say it go by way of the dinosaurs, but it's really going to slow things up.
No,
it is so much more efficient.
I'm with you.
To do things electronically. And then I have individuals who don't trust the automation in terms of automatic debits from bank accounts. They are so determined that, everything has to be done by the mail. And we know what's happened by the mail. The mail's had problems too.
Yep.
Put this all together, Dan, it has caused a lot of problems. And all you can do is learn from your mistakes.
Sure. Speaking of 2019 returns, I was surprised to see in your article that some folks might have received notices in error that they didn't file their 2019 return.
In early February, IRS erroneously sent 260,000 notices to individuals stating they had not filed their 2019 returns, when in fact they had. But then, about 2 weeks later, on February 18th, the IRS issued a statement that recipients should disregard these letters. I don't know about that.
Yeah.
I don't think you should just throw the letter in the trash or recycle it or whatever. They should really follow up and just call IRS. There's an 800 number there just to confirm that the letter was sent out in error, that they filed their 2009, get a confirmation that the IRS received their 2019 return, and just don't ignore it as if it never happened. That's the worst thing you can do. I say that in general. The worst thing you can do when you get an IRS notice, take it seriously.
Absolutely. And you closed that article with steps folks can take to prevent problems in 2022. So why don't you walk us through some of those?
Yes, Dan. I think the same problems that are around now, I don't see any real solution. IRS is going to be backed up. There's going to be paper returns. And the phone calls I received, the emails I received from irate clients, where's my refund? I just like to share an example, what I told this person. So this client got a refund of $16,000. She loves big refunds. Why? I don't know. I've told her time and time again. This big refund's doing you no goods. And she says, it gives me such a good feeling to get that big refund. So she's so irate. She filed her return in early March. She got her stuff to me right at time. We filed it, $16,000. She's thrilled. Then she emails me about 2 weeks ago, I haven't gotten my refund yet. This is disgusting. What is wrong? And I try to explain it to her. She says, no, I don't believe it. This is terrible. IRS should be sued for this. Well, you can't.
Good luck.
I think you should learn your lesson from this. Well, what can I do? I got my stuff to you on time and so on. I said to her, look, I'm looking at your return now. She's retired and she gets Social Security. And when it comes to Social Security, it is taxable. And you can ask that the Social Security withhold federal income tax. You can ask that. It's strictly voluntary, but Social Security will only do it if you ask them. So she purposely withholds the maximum amount possible from her Social Security check. To give you an idea here, she got $16,000 of Social Security payments, and she had $10,000 of withholding, leaving her $6,000 during the year, $500 a month Social Security net check.
Wow.
And her refund is over $16,000, meaning that $10,000 was not needed.
Right.
So I said to her, why don't you stop having the Social Security withhold federal income tax? You can stop it because there's your refund right there. There's $10,000 right there of your $16,000 refund. So if individuals do, in fact, get a big refund, how do I define a big refund, Dan? How do I define a big refund? My opinion, if you get more than $1,000, that's too much.
Gotcha.
The government's holding your money. If you're getting a significant refund, Now is the time to decrease the amount of your withholding, whether it's from a paycheck or if you're getting a CSRS annuity check or a frozen annuity check or Social Security, TSP withholds federal tax. Decrease the amount of your withholding. This way, more money will be in your pocket throughout the year. You don't have to wait for that big refund come next spring.
Makes sense.
I always say, Dan, the most important tax planning you do is between June and December, not between January and April, because you have time to fix things so that there are no surprises come next spring.
Gotcha. Any other tips for our feds?
I would say I want to go to the other extreme. If you owed a lot of money, let's say you owed a lot of money. And how do I define owing a lot of money? More than $1,000.
Gotcha.
Think about change your withholding to have more tax coming out. Or if you're still a federal employee, consider putting more money into the traditional TSP, because your traditional TSP contributions will result in less taxable salary. You owe less tax come next spring. So it works both ways. I want to point out that the IRS has a very good withholding estimator. If you go to their website, and in the article, I have a link to that Irs Withholdings Estimator. And now is a great time of year to get to that estimator, because you got plenty of time. You got 7 months left of this year.
Sure.
To change the amount of withholding. And estimator is very easy to use. I've worked with it. If you have a tax professional you work with, now's the time of year to go bother your tax professional and do some tax planning for the rest of the year. I'll repeat, the most important time of year to do tax planning is between, I'll say, June and November, where we still have time to fix anything that's wrong, not between January and April.
Yep. Once that year turns, you can't do anything. Okay. Great tips, Ed, as always. And the guru has done it again. So let me ask you this, Ed. Since this is all fresh information this year, might you be touching on this, any of your webinars?
Yes. As a matter of fact, we have, as one of our monthly webinars, we always have what's called a tax planning webinar.
That we do.
We just had one last week on May 13th. We're going to have another one in June. On June 9th, I have the schedule here. And we're going to have another one in July, of course. That'll be on July 15th. So we really try to make sure that feds are up when it comes to taxes. The theme of the webinar is tax planning for retirement, but we do talk about tax planning presently, what you can do to minimize your tax bite now. But again, we don't want any surprises come retirement. So we try to prepare feds for retirement in terms of what they can expect tax-wise. We talk about not only federal taxes, we also talk about the states. One of the topics we cover, what are good states for federal employees to retire to? There are good states to retire to in terms of maybe lessening your overall tax liability. We're not only just talking about income taxes, Dan. Many feds think that, if a state has no income tax, that's the best place to retire tax-wise. Not necessarily.
Yep.
It depends. If there are other taxes you got to worry about, like death taxes, property taxes, sales taxes. There's no freebie out there, Dan.
Boat taxes.
Try to get them prepared.
Yep. Okay. Ed will always find a way to help you with these things, and I will always find a way to work in a plug for the webinars. So do not miss Ed and Jennifer Meyer. They are a dynamic duo. And also we've added Matt Kramer to that. So we are going to have just a crew of people out there providing these webinars at times to be convenient to you. So you have the opportunity to get boned up on this. Once again, Ed, I have to thank you on behalf of the feds. No one's putting this information out there. And again, I still marvel at how you keep it all straight. Don't know how you do it, but I'm glad you do it. I'm glad you do it with us. Thank you, Ed. So, folks, that is a wrap. We are Serving Those Who Serve. Be sure to subscribe to this podcast on your YouTube channel or Spotify. Please remember to share it with your friends, strangers, and even the occasional enemy if you like. Check us out on Twitter and LinkedIn. Don't forget our live webinars every week. We already touched on them. You want to find them, just go to stwserve.com and you will see the red webinar button on the landing page. Now, if you happen to see that our page has changed, That's still us. We will have a new look going live in the next couple of weeks. Have a great crew. Big shout out to Outright for helping us design that. And if you notice that you are listening to Eddie Z in HD, big shout out to our director and engineer extraordinaire, Eric Johnson, for helping us sound great here and reminding me not to click my pen when we record these things. So hit those webinars. The guru will come to you. You can watch in your bunny slippers as we work to reach, teach, and serve you. Reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all. Be sure to read Ed every month, as I've hit this a million times, in the Fed Zone. That's fed-zone.com. So, heading out for Ed, the crew in Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your FedLife. Make it a great one, because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FedLife Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.